Welcome to the Tax Talk podcast. Are you a business owner thinking about stepping away from your company, but unsure how to do that properly? On this episode, I will be chatting with Travis Koivula. He is an investment advisor with Pilon Savings and Wealth Management, and together we'll unpack the key considerations for a successful business exit and succession plan. Travis, thank you very much for joining me on today's episode. I'm fairly certain I butchered your last name.
You absolutely did. It's great. And no one says it right the first time. So this is good.
But I even asked you ahead of time, and I said it, underlined it, thinking that would get me at the right place. But here we go again. What do you do?
Yeah.
Anyways, today's problem: many business owners spend years of their life building a successful company, but leave the exit planning until it's too late. Whether it's uncertainty about valuation, taxation, or how to transfer that business to the next generation or to a third party, exit planning is often overlooked, leading to stress and financial uncertainties. And worse comes to worse, what I think is the breakdown of that family unit if you can't get that business transferred in a realistic time period and under terms that everybody can abide by. So today, we're going to touch on a couple of key areas. Travis is going to give his insight. I'm going to bounce some ideas back and forth. If you're in the exit planning era of your business, this episode is definitely for you. So, Travis, when is the best time to start planning for your exit from that business?
It all varies. I think 3 years out is kind of a minimum. You want to be thinking about it. And Jared, you might find this surprising, but most people don't jump at the chance to go get life insurance on themselves. Most people don't jump at the chance to get their will done. And most people don't jump at the chance to plan their exit because something has to happen for that to take place. And so it's easier just to push it off, kick the can down the road. Let's deal with it later. And an exit, it's not like selling a house in a hot market where you put it on and it's gone. The process takes a long time, right? You got to have your ducks in a row. And the last thing you want to do is I need to sell, I'm done mentally. Oh man, like that's putting a lot of pressure on it. And so you don't want to sell when you need to, you want to sell when you want to. And so there's a bunch of pre-work that has to go in. Let's use the example of selling your house. I'm not going to bring someone over to my house today. My kids have destroyed it. They've been off school. There's junk everywhere. We're going to clean up. We're going to get rid of some stuff. We're going to make it look the best possible. Same thing when you're selling your business. You want to put your best foot forward. You want to, refine the numbers so everything ticks all the boxes and it can go. I want to ask you this. So the window to sell your business, I think it changes. And so, imagine in 2019, you're getting ready, end of 2019, I'm going to sell my business next year. And then COVID happens. And so that window of buyers out there probably shrinks quite a bit. There's uncertainty. And so it might be kind of tough to sell your business through 2020, 2021. Starts opening up in 2021. It's wide open. Great time to be selling businesses. And then we go into 2022, March, interest rates start going up. Window closes again, right? And so through 2022, the window to sell your business is closed. And then it opens up in 2023. And then beginning in 2025, we got tariffs and uncertainty. And so there's these windows when you really want to be selling your business. And to take advantage of that, you have to do all this pre-work and have things ready to go. What are your thoughts on that?
I would 100% agree. And it's probably something that comes up with your clients on a regular basis. You can't buy and sell the market if you're just talking stocks in general. So why would you ever think that you could do the same thing with your business? Like you said, the market for potential buyers is going to be considerably lower than it would be for some publicly traded stock. So the only way, and I 100% agree with you on this, the only way to ensure that you're going to put yourself in the best possible position to sell that business is if you have the planning done at the onset and you're continually adjusting for that. So when the time does come, you're in the best possible place to pull the trigger. The terms are going to be better. The financial payout's going to be better. who you actually move that business onto. You're probably going to have more ability to make that decision, as opposed to what you said earlier. You get to the end of the line, you're burned out. You just wake up one day and said, doesn't much matter anymore. Fire sale this thing. Let's get out of here because I'm done. You're going to get the worst possible deal that you can get if you approach it in that manner. So yeah, you need to put that plan in place. I would agree, a minimum 3 years. And then you have to understand that it is an active and live plan. You don't just sit down one day with your advisor or your accountant, you hash it out for 4 hours, and then you take that thing and you throw it in the back of the closet. It has to be an ongoing plan. Also, COVID came, the tariffs are here. What are we doing to, change our plan to make sure that when we want to sell this thing, we're in the best possible position?
And I think, when you are starting to exit and you've got a deal, there's deal fatigue. And I'm not sure if you've ever you fell in love with something at the store. And the worst thing that salesperson can do is to let you go home and sleep on it, because then you don't start wanting it as much. And the same thing happens with a deal, right? You've got an active buyer, and the longer this thing drags out, they need this report, they need this report, you need this restructuring done, you need to clean up your employees' benefits plans, you need to, do certain things. Well, that buyer could just go, yeah, I'm not really, they're going to fall out of love with your business. So there is a fatigue. Like once you get someone on, it's a race to the finish. You want to go, get this thing closed as quick as possible, because there's just so much risks and stuff could happen in the economy where they just back out. And so it's just a full out race. You want to be ready to go and have everything they need every time their accountant's asking for, depreciation reports or whatever it is, you've got it ready to go. So, that's something I think that people don't think about. The deal fatigue is you want to do a lot of pre-work so that doesn't come to bite you.
Yeah, that's an excellent point. I mean, you want to make sure that you put your best foot forward. And if that right deal comes across the table, you're in place to pull the trigger immediately. Because I have been involved in those where you get these larger companies coming to buy mom and pop up. It takes a long time for that process to play out. I mean, everybody's putting in the proper legal paperwork and there's all sorts of things that go into it. And if you don't have those systems in place to show that, a bottom line profits that you're turning are substantiated by some underlying processes and people, you very well easily could throw yourself under the bus, and that's not what you want to do. So making sure you have all your ducks in a row, good plan. Sure.
Another thing to think about is when these mom and pop operations, a lot of people that are buying a business don't want to actually run the business and don't want to buy themselves a job. And so if you're paying yourself a salary of $100,000 a year, they're going to back that out of the pro forma. And people just don't think about this, right? Like they're going to hire somebody to do your job for you. And so, and that's going to reduce the value of your business. So the more you're doing in your business, the less your business is going to be worth. So, kind of tough to sometimes hear those words, but the less you can do in your business, the more it's going to be worth, because somebody else can just buy it and, let it run it by itself.
I would agree. I mean, the biggest thing that I learned when we purchased that book of clients and that office space down in Ditchbury was the importance of having everything documented. So you're able to move those processes into this new office. You're able to just kind of hit the ground running and go. And if you don't have these things documented, everything's up here, all the value is internalized. I mean, it is much harder to make that transition. So I would agree. You should always be planning for that exit. It's going to happen one way or the other. Whether you can get yourself to the position where you can actually take advantage of it or not is entirely reliant upon what you do in the leading up to that period of time.
And, nobody likes to write standard operating procedures. They're boring.
Oh,
no one does. But really important. And there's a great book out there for every business owner called Checklist Manifesto. And so it's written by a physician. And they, you think surgery is like ultra important. People's lives are at risk. There's a ton of mistakes that happen that can be avoided with checklists. And so when you fly a plane, a pilot actually has to go through a checklist. And then once they start introducing these checklists, plane crashes drop dramatically. This physician was arguing that there should be more checklists in medicine. And I would think like same thing, standard operating procedure checklist in your business. Those are going to make your business that much more valuable and avoid it from lawsuits. And, just to have somebody else that can come in and train your employees easier.
Yeah, that's an excellent point. I mean, your business really is only as valuable as some of that underlying procedures and processes, because if you have gone the entire period, you've built all the value within yourself, all of the information, all the relevant, client and supplier data is in you. If you disappear, well, how's anyone supposed to take this on? Like you said, someone's probably not buying this to get themselves a job. They want to buy this as an investment for themselves or their existing corporation. So you need to put everything in place to allow them to just walk through the doors, let everyone keep doing their jobs. You step aside, life goes on. They see a return, everybody's happy.
Yeah. I had one client, he was selling his business. I was like, okay, trying to describe, he's like, and he pulls out this old, flip phone. And he's like, this is the business. And I said, what do you mean that's the business? He's like, this is the business. It's got my Rolodex of all my clients and everyone's got my phone number and everything. I thought, oh man, if that thing gets crushed by a car or something, like this is bad news. This is not what we want to be seeing for a business plan. So that's kind of worst case scenario. And then, it goes up from there.
Sure. All right. So let's get into some common exit strategies. So we got a couple notes here: family succession, management buyout, and third-party sale. What do you want to throw out there in regards?
Well, I was going to say for family succession, I was curious in your experience, how often do you see that work? And like, how often does that come up in a business?
It's tough. You definitely see it. I would say more so probably on the ag side of things. It seemed to be a little bit more of a natural fit. As far as a traditional business, I am working with some clients in regards to this. I find the biggest issue that we run into is just the existing or the founding owner's willingness to give up control. And irregardless of how long that child may have been involved in the business, has been able to provide, proof of their value and understanding of the operations, there is just this inherent, I don't know what it is, a lack of willingness to just give up control just in general. And sometimes it could just be the slightest thing because, I'd suggested, maybe we give up this aspect of the corporate structure, or we, of this part out, that we start to kind of at least work the plan and move it ahead. And I'd find that to be the biggest roadblock. It's not so much the tax, it's not so much the dollars that are going to come back. I think it's just, in general, and I could probably see this for myself down the road, I have a lot of inherent value and a lot of, self-determination from my business, and just stepping back from that, I think would be hard because my identity is so ingrained in the business. So I think that is always going to be the hardest thing, is just convincing people that there are things to do beyond just running that business and allowing their, kids to kind of take over from there.
How do you find planning around other kids? So we've got one child that's buying the business, and then other family members may feel like, hey, they're getting an advantage because they're getting to buy this very profitable business and we're, doing something else. Has that ever come up with you? And curious what's kind of happened with that.
It does. Again, that's a tricky situation to navigate. So generally speaking, for a lot of small business owners, they have a significant portion of their wealth that's tied up in the business. So if you have, child A that's willing and able to kind of continue that business onwards, whereas child B, potentially more, isn't interested, doesn't have the ability to do it, the biggest concern then becomes, how do you equalize everything? If you're giving the shares in whatever shape or form to child A, how are you going to get some value to these other kids? Life insurance comes up. That's a particular option. But again, there's a lot of people that have some reservations on doing that. Maybe they're older in years and they don't want to go down the insurance route. So that is a difficult conversation to have, but you need to figure it out in such a manner that it's going to keep that family together. Because in my opinion, the worst possible thing is mom and dad eventually pass away and the siblings no longer speak to each other. I don't care how much, tax planning and tax savings that you put into place. If the kids are no longer speaking to each other on Thanksgiving, I think you've done a disservice to the client. So I think it's very prudent to have a very, encompassing team, account advisor, etc., to really look at all angles of this and try and find a solution that's going to work best to keep that family unit in place.
I think from my perspective, a couple things I think is the conversation through it. Okay, like, son, daughter A is buying the business. This is what's happening, and buying it at fair market value. And so if you get an appraisal done, they buy it at fair market value. Like, what more can you do? Like, they're not getting a deal on it. Like maybe the buyout's a little bit longer because it's a family business or something. But if you're transacting at fair market value and the other siblings know that, I don't know how much more you can. There still can be hurt feelings, especially if that child A grows the business and now it's worth a lot more. It's like, hey, I missed out on this great business. I should have been able to ride the coattails. Well, no, not very many active businesses have silent shareholders that aren't contributing. How fair is that to the person that's putting their blood, sweat, and tears, sleepless nights, stress is all landing on them and you just get to ride the coattails. So no, like the business owner is actually going to be like, doing all the work. And so we're not going to have any silent shareholders in there just because it's just not fair for them. So I think that transparency, everyone knowing, having family meetings and letting them know what's going on and why. And then if they want to, participate in that, in showing what that would look like. So that's one. I just want to talk about third-party sales and how tricky they can be, because as a business owner, you're it's not like real estate. You want everyone to know you're selling your house, so someone might buy it. It's kind of the opposite because you got clients and they might be attached to you. And then if you're telling them, oh, I'm going to be selling, oh, I might look for somebody else. Somebody else has been kind of approaching me. I might leave. And there's some risk there. Maybe a competitor is going to buy it and you show them your books. And so there's a whole bunch. So you just got to get your kind of head around what that looks like. And so what I've seen is if you're going to sell to a third party, oftentimes it's not going to be a competitor in town. It's going to be somebody that's coming into your location to try to open up a shop. And this is the easiest way for them to get market traction. And there are business brokers that do this behind the scenes and they know who to contact. There's also, I've seen private equity come in and they're assembling all the, plumbing companies in Western Canada together. So there's one in each location and they're going to create the next, super plumber or whatever it is. And then, right. And they're going to buy you out because you're going to be the Red Deer or the Victoria equivalent to that. And so that's where third party, like putting it up on the website, hey, I'm selling my business, less appetite, less opportunity. You don't see that too often. It's usually behind the scenes, that the off market deals, we would call them. And then the management, so your management buyout, how often do you see management outside of family buy a company?
I'm starting to see it more and more. I had dealt with a client specifically in the last couple of years in regards to this. And it's kind of a nice way for the founders to take a bit of a step back and then slowly bring in some key employees into that ownership fold. And you're able then to kind of retain that control, still manage the business in a way that you kind of see fit. And then you're able to kind of judge, maybe what's their long-term potential, what their long-term interest is. And then it gives them the ability to have a bit of a buy-in and kind of see where the fruits of their labor are actually going to go to. When I think I could see this being a bit more of a common practice as we kind of move over in some of these transitions over the next number of years. I think there is a bit of a push. They have put out different employee trust rules here recently.
I was going to ask you about that actually. If you haven't seen anyone, I
haven't seen anyone take part of that. They are a little bit tricky to navigate, and I think you have to be of a fairly significant size to kind of make it worthwhile. But again, dependent upon your business, it could be a very useful tax tool to kind of move that into the next phase of ownership there. So yeah, there's numerous options on the table, and just making sure that you adjust them ahead of time is going to put you in the best position to take advantage of it. So
for those listening, the employee trust, ownership trust, there's a $10 million potential like gain, that can wipe out. No, that's not taxes that you're saving. That's just gain.
For sure.
But lot of specific,
Yes.
and so definitely talking to Jared and his team about what that looks like and preparing your business for that. Because I could see that being one where like not very many people are going to be able to do it, but if you can, you definitely want to take advantage. So yeah.
Yeah, I mean, generally speaking, like anything, I just say really the most simple way to get from A to B is going to be the best route. So, I mean, if the employee ownership trust is the best route, then so be it. But if you are reaching to kind of put this in place, let's maybe look at some simpler options.
Absolutely. Yeah.
For sure. What are some tax implications of a sale or a transfer? So I know you reached out to me earlier. You had some questions in regards to holdco, opco. I had to throw that in your ballpark. You let me know what you want to hear on that.
Yeah. So like this comes up all the time. I'm talking to folks and somebody's got an opco, the holdco owns it, right? So a holding company owns the operating company shares. And in the holding company, they've got some real estate, they've got some investments, they've got a whole bunch of things going on. And then they want to sell the opco. How do they take advantage of the capital gains, that capital gains exemption, tax-free sale? Like, what does that look like?
Yeah, so that's a tough one. I mean, the corporation can't claim that lifetime capital gains exemption. It's an individual that can. And like you had mentioned, if you've got some sort of real estate or some investments in that holdco, chances are that particular corporation is going to be offside for any of these active business rules. So you're going to be not in good shape as far as claiming capital gains exemption in regards to this. Generally, how I structure these particular opco, holdco scenarios is if opco gets to the point in time where I've got some passive investments, whatever they might be, typically owned by husband and wife, I then introduce a holding company and I restructure operating company. So I move all of the values from the existing common shares into some preferred shares. And then from the new issuance of shares from treasury and active company, I usually give 44% to the husband, 44% to the wife, and then 12% to the holding company. So as long as if you have in excess of 10% owned by the holding company, you could still flow through any after-tax profits as a tax-free dividend. And then that way it preserves as much of that share ownership, I mean, 88% of it, as a potential share and sale of small business shares that the husband and wife could then claim on their personal tax returns. Yes, you're going to have a bit of a leftover there, 12% that's going to be taxed up in the holding company. But I just helped a client do this recently. A number of years back, we did this exact same thing. We just restructured everything. He went the necessary period of time as far as the holding, and he found a buyer through one of those online dealers, got everything set up, and this is how it translated out. And overall, it worked out really well. We removed a fairly significant investment portfolio out of there. Now got that all set up in holding company. He's rolled into some new ventures, and we sold off those older shares, and it worked out really well. So that's generally how I deal with that. And again, it boils back to that first point we made. Planning ahead is going to put you in the place where you're able to take advantage of this. If you sit on a pile of cash or GICs or whatever the case is, and then someone comes through the door and says, well, I'll give you a couple $1 million for your company, chances are you going to be outside on these rules, and there's nothing you can do unless you pull the trade in tax.
A couple of things I wanted to bring up. Number one, keeping a bunch of money in GICs. All business owners do this, right? $1 million in a cash flow GIC might need it. And so CRA definitely doesn't like that. Right. And so just be wary of that. In general, like without the limited capital gains exemption, what if an operating company is holding these like big amounts of cash in there? Like, what are your thoughts on that?
So I've looked this up for a client here recently, and we just kind of put in this particular scenario here where we needed to reorganize everything. But they had a significant cash balance in there, and when you look at the balance sheet and you just look at that line item, you would say, oh, well, they're probably offselling it. That's well in excess of 10% of their assets. But when you drill into it, you look at the current payables, you look at the current payroll, you look at the ongoing payments on the leases and the loans that they have. If you were to strip away that cash, they would be in a significant cash crunch within 1 month. So I looked up some rules in regards to this, and there is some language in there that says, looking at working capital, there are ways to kind of justify that a business needs X amount of dollars. You can't just stay on face value, oh, you've got $500,000 sitting in the bag, you're offside. You have to look at the bigger picture and say, well, if you didn't have that $500,000, you'd go broke and have issues with all sorts of people next week. So you got to kind of take it with a grain of salt. It's not just looking at one line item on it.
What about a family trust in regards to doing that? Because I've a number of clients have been talking about that. They want to know about that. If this is maybe another show topic, but if you want to briefly just go over it, or we can maybe tempt that with another show. So
sure,
yeah,
sure. Yeah, I'll briefly touch on it. We could get into it more detail. It has definitely become less useful over the past number of years. There have been a number of rules that have been put into place that definitely restrict the tax benefits of family trusts. Just the overall TOSI, tax on split income rules that came in 2017, that hampered things. And then the rules over the past couple of years in regards to alternative minimum tax that impacts trusts. So traditionally speaking, if mom and dad had some value in that operating company and they wanted to move it into that family trust with the eventual plan to kind of sell and then disperse the capital gains there, traditionally you've got some sort of a note that has to come back with interest, and the AMT rules that are in place now do not treat the interest on that very favorably. So in recent, I have seen a lot of these being collapsed. We have maybe 1 or 2 left, and they're there for more legal liability purposes as opposed to the tax planning thing. So definitely reduced value as far as tax planning goes on those.
I would agree with that.
Importance of having a shareholder agreement, contingency plans. What are some of your thoughts on this?
Yeah, I always joke that if an insurance agent does up a buy-sell agreement, there's typically not the actual buy-sell agreement in place. And then if a lawyer does up a buy-sell agreement, there's usually no funding in place. And so you really want to have your team, coming together and working in one thing, saying, hey, we got this buy-sell agreement for $5 million for this business. Where's the money going to come from, right? Like you pass away, number one, we're losing a key employee. Number two, we're going to buy out your spouse or your family for a big chunk of change. We need some, and this is, once again, no one likes to do buy-sell agreements. No one likes to buy life insurance or talk about it, but it is pretty important. So I think that's just something to keep in mind, that if you do have a buy-sell agreement, determine where the funding's from. And it's like, not, oh, we'll be fine. Pretend you pass away and there's a big recession. Pretend you pass away and your biggest suppliers or your biggest customers just left you. Pretend it is the worst case scenario and your business needs cash. Would you want to have, maybe not all the buyout, but a big chunk of it coming in to buy out the other partner? I got a question for you. Have you ever seen a deal fall apart right at the last minute? When someone's like selling their business or buying a business, and then at the last minute, just falls apart?
Don't think so. From the top of my head, I think all the ones that I've been involved with, albeit some of them have dragged on for a extended periods of
long time. Yeah.
And yeah, I don't know how some of them deal with it, because I get I'd be dealing with it. But yeah, I don't think I've seen anyone pull out last minute or anything like that. But yeah, there has been some ones that they do not hold on. So.
Well, I've seen it.
Okay.
And just for nothing, like just lawsuit came up, something else happened, and all of a sudden the buyer's like, an event came up.
Sure.
And so I think clients start to, once they, they're mentally checking out of their business number one, right?
Yes.
We got a buyer, we're racing towards the finish line. And then they start imagining, oh, I'm going to book this trip, I'm going to buy this boat, I'm going to do this, I'm going to do that. And you start spending money at a rate that you really, probably shouldn't be doing, because you're getting this money, right? It's coming through, and then it doesn't. And it's like, whoa, like we've spent the money. And so my thing is like, don't make any big purchases or make any big plans until you're a year out of selling your business. Number one, you're going to have to file taxes. Like there's all estimates, and it's probably, you can't mention it right back at the start. It's going to be around this, but like we're long past that. We've forgotten. And so you're going to, need to keep some money around for taxes. You don't know, just know how much you've got. You're probably going to pay down some debt. And so just get to a place where you're, before making any big purchases. And so that's my big thing is that, it's human nature to start to spend this money before it comes in, and deals fall apart at the last minute all the time. And I've seen it, a few times. And so really just caution people to wait until, and what is your contingency? So say this deal falls apart. What is that going to look like to you? And do you have plans in place?
Right. So in bringing that up, I do actually recall a couple situations, more so on the vendor take-back side, that I have seen fall through, one of which being I don't know what you call it, some motel, hotel type property that was sold. Owners took back that vendor take-back, and for whatever reason, the new owners basically deserted the place, and as you would expect, the loan payments dried up. They had to go through an extensive battle to get back onto the property, to be able to attend to it, to get the utilities back in their name, to preserve the one item that was associated with this sale that had any value whatsoever, to be able to kind of keep moving on, because that was their retirement strategy, selling this property off, taking the proceeds and moving on. And then when that didn't transpire, it turned into a bit of a headache as a result of having to go through all the hoops to get the building back into their name, deal with all the outcome of that, and then proceed onwards with rerunning this business, because now they have a year or whatever behind the fact. So, contingency plans for that, very important.
I was going to talk about this later, but vendor financing, vendor take-backs, let's discuss that. So when someone's selling a business, the buyer will go and they'll have some money themselves, but they'll go to a bank or a credit union, hopefully a credit union, and get a loan to buy the business. Oftentimes, there's a mismatch between what the seller wants and the buyer can get financing for and has. And so that will come through what's called a vendor take back. And so it's a loan outside the bank loan. So the bank may have a loan, on that building or whatever, but then the vendor will have, and it's a higher interest rate for a shorter period of time, just like to get it back. And so when you're selling, you got to be really comfortable. Like, am I going to be willing to take that? Because there's some risk involved with it. So like the better the business looks, the less, probably more comfortable you'll be taking a vendor take back, but also, so do you see vendor take backs quite often?
I would say so. And you would typically see it in a family situation for sure. If you're bringing in the kids, chances are they don't have a whole pile of cash sitting around to buy in. There are definitely times where third-party arrangements do happen, some of which I've seen work out just fine. And then I have seen others in other cases epically fail. So you need to be very comfortable with whom you are selling to put a lot of faith into what they are going to do with that business, because the profitability of that business is then going to determine the payouts that come to you after the fact. So if you are the least bit leery about how that business is going to be run after the fact, I think you need to put a lot of stock in determining whether or not a vendor take back is appropriate for you. If you're selling maybe early when you're a little bit younger and you can maybe take some of that downside, then you can maybe go with that risk. But if you're getting into those retirement years, you're relying on this as your nest egg, I might have a second thought on that vendor take back.
So along with vendor take back, there's an earnout. And so we should talk about that when selling a business. And an earnout is when the owner stays on and continues to run the business and can earn a higher payout for the business if the business hits certain metrics. And so that is another tool that you can use to get the price you want in your business. But you are working and you are running the business, and there's some risk that you may not hit those targets. It reduces the risk on the buyer's side because they have, the established business owner with skin in the game working for that. Do you see those too often?
I have. most notably just kind of wrapped one up. They had moved everything into a family trust and they were just receiving earnout payments over the course of a number of years. So it definitely does come up. I've seen it in a number of cases in some of these oil field companies that get bought out by some bigger operations. A lot of these earnout agreements put into place there. So yeah, again, you need to make sure that you've got some confidence in who is going to be managing this to make sure that they're going to be hitting some of these targets, because you want to see the earnout. They don't necessarily want to see the earnout because you've got differing and competing interests here. So yeah, need to make sure that deal's structured accordingly and you've got some faith in whoever's taking that business over. Travis, I do need to get this wrapped up. We are running out of time here. It has been a good conversation, and I think we're definitely due to maybe follow this up and touch on some other topics that have kind of cropped up over the course of this podcast, for sure. So to move forward confidently in your business exit journey, what are some additional steps that you can take? Number one, please subscribe to the Tax Talk podcast, whether you're on YouTube, Spotify, whatever the case might be. Feel free to subscribe. Throw some comments down in the chat. Me and Travis would be happy to follow up with you on any of those concerns. Also, touch base with us at Legacy LLP. We've got lots of resources on there, blog posts, etc., that will provide you some additional insight into the business exit planning aspect of life. Travis, I just want to say thank you very much for taking the time out of your busy schedule to hop on the podcast with me. If the viewers want to get a hold of you, what is the best way to touch base with you?
Yeah, you can find me on social media. I got a very active LinkedIn profile, a very active business Facebook page, and a very active business Instagram page. Got lots of great content. I think you'll really enjoy it. So please follow me on any of those platforms.
For sure. Yeah, definitely. Travis is a good follow there. He's got some interesting and exciting ways to deliver some of the not so interesting investment and tax topics. So definitely touch base with Travis on any of those social media platforms. And again, for the Tax Talk podcast, I'm Jared Bond. Thanks again for watching, and we will see you on the next episode. Take care.